The term is actually more important in the long term than the interest rate is sometimes, because your interest that you pay back is dependent on the term much more than the interest rate you pay on the front end.
So can you walk us through that?
I can.
Okay, so explain that again. So you're saying a 30-year or 15-year might be a more important decision than seeing, okay, I have a 5% rate on my mortgage.
Interest rates are very important in helping you get a lower payment, and that will also help you to leverage to get a shorter term. But when you look at the overall cost of a mortgage loan, the biggest cost is in the total repayment of that loan. So many times we'll go in and we'll lower our monthly payments on the front end. We'll save $50, $100, $200 per month, but extend the back end term by $100,000 in payments. And actually, here's a very little known thing. When you do a rate and term refinance, your taxes actually go up because you're lowering your interest rate, you're lowering your interest deductions. Therefore, you're going to pay more in taxes. So what happens is we lower our payments, but we extend our term. We end up increasing our taxes, and we pay fees and costs to get the loan. It doesn't do us any good. If instead of doing that, we could instead take that interest rate, that low interest rate, get a shorter term while we lower our payment, maybe get a little bit of cash. If our emergency reserves or cash reserves are down, pull a little cash out. That does two things. That protects your equity, because remember, your property value is dropping right now. So by pulling a little cash out, you're actually pulling out equity, converting it into cash. If you can put it in a savings account, something very sound, very safe, very conservative, you'll earn a little bit of interest on that money. You'll gain a little bit of tax benefit, and it'll end up being a better loan for you in the long term.
Well, that's a good way to look at it.
That is
That's something I didn't even think about.